Wall Street, 1987. Stock markets raced upward during the first half of 1987. By late August, the Dow Jones Index had gained 40% in a matter of a few months. In the 5 years preceding October 1987, the Dow Jones Index more than tripled in value. The stock market was a raging bull. Deal-making activity has been very strong. Most experts believe that the current wave will continue. People are making a lot of money. In 1987, the Federal Reserve tightened monetary policy. Growth in the U.S. money supply plummeted, interest rates rose, and stock prices began to fall by August. In the 1980s, many of the deals were hostile takeovers. These deals were usually financed by high-yield debt, so there was also a high amount of leverage involved. With interest rate rising, the party is close to end soon. On October 13, U.S. Congress introduced a takeover tax bill that would have placed restrictions on takeovers. This bill would have repealed many tax breaks related to M&A activity. Many of the takeover stocks fell sharply following this news. Liquidity was diminishing. Many risk arbitrage hedge funds could not meet their margin calls by only selling the takeover stocks. These funds had to sell what they could sell. The house is on fire and the stock market bubble burst. The weekend break offered only a brief reprieve. U.S. Treasury Secretary James Baker on Saturday, October 17, publicly threatened to devalue the U.S. dollar in order to narrow the nation's widening trade deficit. In October 19, 1987, as the opening bell rang in the U.S., chaos erupted. The stock market crashed, triggering the infamous portfolio insurance and algorithm trading, which only added fuel to the fire. Panic spread like a virus as prices continued to decline rapidly. When the dust finally settled, the Dow Jones Index had finished down a jaw-dropping 508 points, or 22.6%. Global markets also collapsed. The worst decline among world markets was in Hong Kong, with a drop of 45.8% in its biggest ever single fall. It was a day that would go down in history as one of the worst in financial memory. The entire American financial system seemed to be on the verge of collapse, and the world watched with bated breath, wondering if this was the end. Some hedge funds suffered huge losses. Being one of the largest hedge funds in the industry, George Soros' Quantum Fund incurred a staggering 30% loss, amounting to approximately $6 billion, during the crash. There were few savvy fund managers who bet the stock market crash. Paul Tudor Jones' hedge fund yielded an impressive return of 125.9%, estimated to be around $100 million in 1987. In a statement on October 20, 1987, Fed Chairman Alan Greenspan said, "The Federal Reserve, consistent with its responsibilities as the nation's central bank, affirmed today its readiness to serve as a source of liquidity to support the economic and financial system." Behind the scenes, the Fed encouraged banks to continue to lend on their usual terms. The 10 largest New York banks nearly doubled their lending to securities firms during the week of October 19. Unlike previous financial crises, the 1987 stock market decline was not associated with a deposit run or any other problem in the banking sector. However, the impact of the crash was significant, and many people's lives were dramatically affected by the loss of wealth that followed. 2 years later, U.S. stock markets reached new highs. As Jesse Livermore once said, "There is nothing new in Wall Street. There can't be because speculation is as old as the hills. Whatever happens in the stock market today has happened before and will happen again." Thus, we are reminded that the 1987 stock market crash, while a momentous occurrence in its time, is but one chapter in a perpetual narrative of market upheaval and renewal.